Good day, everyone. My name is Tamara Kukshinovich, and I'm going to take you through the Woolworths interim results. Woolworths is currently trading at a discount to its historical averages and peer multiples. We feel that concerns regarding the material structural and cyclical challenges, as well as the strained balance sheet, are fairly reflected in the current valuation. Before we consider an investment in the share, we feel it is prudent to wait and see if there is a recovery in trading conditions. This is why we recommend a neutral position in the counter. Food is the most attractive operation since it consistently produces growth ahead of the market. However, consumer spending remains under pressure, and we are concerned how this will affect medium-term results and the division's ability to drive further efficiency gains, since margins are already on a high base and ahead of targets. David Jones remains a primary concern. Investments and losses have exceeded expectations, and management plans to correct the size of operations through aggressively contracting floor space. No further impairment of David Jones is expected. Local and offshore debt covenants are not at risk. The group did revise its dividend cover for the following 2 years to 1.45 times of the South African operating profit only. This is until the debt levels in the Australian operations are halved to 200 million Australian dollars. Black Friday had a big impact on sales since sales volumes increased at discounted prices, margins were lower. Black Friday also slowed sales in December, and sales were impacted by 1 day less of pre-Christmas trade. The Australian market is faced with weak consumer spending. The apparel sector is constrained and is driven by promotions and structural changes such as online sales, which is reducing the mall footfall. Revenue, excluding concession sales, increased by 2.4%. Adjusted operating profit decreased by 11.1%. Adjusted headline earnings per share decreased by 9% to 204.5 cents. Earnings per share increased by 139.3% to 197.5 cents. This was a significant improvement on the prior year, which was impacted by the David Jones impairment. Earnings per share was affected by 103 million rand in adjustments, which include relocation costs, store exit costs, and onerous leases released. The dividend per share decreased by 15.2% to 92 cents per share. Net debt decreased to 11.7 billion rand. In South Africa, net debt decreased to 7.9 billion rand and liquidity remains solid, with unused debt facilities of 5.5 billion rand. Australian net debt increased to 365 million Australian dollars, and this was due to the Elizabeth Street refurbishment, and it is expected to increase to 420 million Australian dollars. The group is focused on decreasing debt levels in Australia. Debt covenants are not at risk, however, the Australian fixed cover ratio decreased to 1.8 times, and it is a concern due to the uncertainty of the David Jones EBITDA generation. Overall, CapEx decreased, but it's forecasted to increase in the next 2 years. Cash flow from operations decreased by 4.7% due to lower cash inflow from trading. The free cash flow decreased by 18.2% due to higher maintenance CapEx. The free cash flow is not enough to cover debt repayments and its dividends, which results in a dividend cut or additional debt being raised. The total cash decreased by 298 million rand for the current year, which indicates that Woolworths is not cash generative. In conclusion, we would recommend a neutral exposure relative to the capped SWIX, which has a weighting of 0.88% in Woolworths. If you would like to place a trade, please speak to a financial advisor or contact the dealing desk. A comprehensive company analysis report on Woolworths can be found on the PSG online trading platform. Before we end off, please take note of the following disclaimer. Thank you.